Welcome to another episode of Coffee with Samso. Today I've got Mike Young here with me, ex-BCI, now with Vimy and Cassini. Maybe just give us an intro and then we'll go from there.
So the accent's Canadian. I've been here in Australia for 32 years and I'm a geologist. So I trained as a geologist and I've always been in the space between exploration and mining, so the resource space and project development. I took up with Vimy when it was known as Energy Resources Australia back in 2013 and became CEO in 2014. We had a lot of work to do on the company. It had a lot of debt. It had a very good project, but it had a lot of debt. And so we recapitalized the company, and at that time, Andrew Forrest put money in. And that was because of my previous relationship with him at BC Iron. And then we renamed the company Vimy. And a lot of people ask me where the name comes from, and it's actually the name of a battle in World War I where my uncle was killed. So it's a town in northern France, and it's named after the Battle of Vimy Ridge. So there's a little bit of something you probably didn't know.
No, well, everyone knows now.
Yep.
Look, I'm curious from the uranium side, because obviously I was in uranium in 2010 with my listing, and then everything sort of went according to plan. You know, it was doing well, and then Fukushima hit. But I want, from your point of view, obviously you've been in that industry since 2013. You have the insights to what a lot of people won't have. There's a lot of perceptions about where it was and things like that. I think that'll be a good sort of insight from yourself.
Well, interestingly, my first summer job in 1981 when I was a student was in uranium. So I worked for the forerunner to Cameco in a place called Uranium City in Saskatchewan, and then I did a couple of winters of uranium exploration in northern Saskatchewan after I graduated, and I grew up in Ontario where we have nuclear power. So I've been associated with uranium on and off almost my whole career. In terms of the market, Fukushima is interesting because it certainly was, I guess, a line in the sand in terms of the uranium market. But the other thing that happened, and certainly it did lead to a downturn in the uranium market. But one of the things that also happened during that period that doesn't get a lot of airplay was the fact that Kazatomprom started to rise to provenance. So Kazatomprom is the national nuclear company for Kazakhstan, and Kazakhstan is currently 40% of the world's uranium. But back in 2006, it wasn't that high. The Kazakhs, they decided that, well, obviously it was a former Soviet republic and they wanted to earn foreign income. They decided to really ratchet up their uranium industry. And what happened was, post-Fukushima, they really flooded the market in almost an elegant way, because they were basically, I suppose, to put it politely, still running what I would call post-Soviet era books, not sort of Western books. And they actually believed, and they stated this publicly, that they would become the OPEC of uranium. Now, the uranium market, as we can talk about, is an opaque contract market. It is nothing like the oil market. It's nothing like any other commodity market. And in doing that, they actually flooded the market. And then on top of that, China, who had a very aggressive inland build, after Fukushima decided to do some safety checks, and that delayed their inland build, all the while Kazakhstan was still producing a lot of uranium. So that then led to a post-Fukushima glut, which was sort of a double whammy, because you had the sentiment of Fukushima and 50 reactors coming offline, although Japan was still buying uranium, plus Kazakhstan really ratcheting up their supply.
Selling
to
the
point.
resource.
Yeah, that's right. So where they became 40% of the world's supplier for uranium. Now, we've been hearing about the Uranium Renaissance for a long time, and part of the reason is that we can see new builds. So the demand side of uranium is very inelastic. If anything, its risk is on the downside because we see premature closures, which I think are going to happen less and less now that we're talking. The rhetoric of climate change is now using words such as crisis and emergency, and people are realizing that nuclear power is one of the only baseload non-emitting power sources there are. So basically, what we saw on the supply side was oversupply. During the last 5 years, we kept talking about this nuclear renaissance. Now, what's different today than a couple of years ago is a couple of things. First is that the Kazakhs have actually westernized their accounting practices and become listed on the London Stock Exchange. Why that's important is 2 years ago they hired a gentleman named Riaz Rizvi, who's been in that organization for a little over 2 years. Swiss-born, Western-trained, was an energy trader with Enron and worked in the nuclear industry, had some uranium funds, understands uranium probably as a businessman better than almost anyone in the world, was brought in to westernize Kazatomprom and get it listed, which he's since done. Something that I haven't seen in the commentary is Kazatomprom now have to become far more accountable to their guidance than they have been at any time in the past. So in the past, they would often put guidance out that was kind of nebulous, and they either stuck to it or they didn't, and you really had to look backwards. There were no leading indicators on what Kazatomprom was going to do. Whereas now that they're listed on the London Stock Exchange, there's a lot more accountability. And so you can look at Kazatomprom and say, okay, they're now behaving like a Western company, and they're now looking at value over volume. And that's a real switch, right? And that's only happened in the last year. The second thing that's happened in our industry is we've seen the entrance of a lot of funds, Yellowcake particularly, who's basically swept up about £9 million out of the spot market. And another thing that isn't getting a lot of airplay is the fact that uranium is effectively sequestered, because Yellowcake is a public company whose share price is based on their net asset value. And the net asset value is how much uranium they hold times the spot price. Now, if they were to sell any of that, what that does is it smashes their share price. So they're almost stuck. They're almost stuck with that uranium until they decide to liquidate the entire fund at some point in the distant future. So these two things are things that are actually affecting both the supply side and demand side. We're also seeing a renaissance in new builds, particularly in the non-OECD countries such as China, through Southeast Asia, and Russia, and the Middle East, something that a lot of people find surprising. There's 4 reactors being built pretty much on time, on budget by Korea Hydronuclear Power. And what we see in those developments...
Is that in Saudi?
That's in the UAE. And Saudi have indicated that they want to build nuclear reactors too. And the reason is they don't have hydro. Burning oil and gas for their power generation basically wastes a resource that they can sell. And they can see that being on the coast, they can use nuclear as desalination as well. So it ticks a lot of boxes for them. And the 4 builds that are being done in Korea basically dispel the myth that we can't build nuclear power plants anymore because it's expensive. It's expensive in OECD countries because what happens is you start building a nuclear power plant, a new government gets elected and they want to change the rules. And any infrastructure project, be it a road, a bridge, a shopping mall, or a nuclear power plant, the moment you start retrofitting new rules on a design that's already started being built, you're going to blow out the cost of the plant. So there's a lot going on in the industry, and a lot of it's a bit like a duck, where you've got a duck on the top of a pond just slowly meandering, but down below it's very busy. And that's why, from an investor point of view, the uranium industry is so exciting, because there's just so much potential and so much about to burst loose.
I mean, uranium's one of those things. I mean, when I started looking into uranium, 2010, I mean, when you look at carbon printing and things like that, it's the cleanest out there. 2 years ago, I was in Liverpool on a business festival thing, and someone mentioned, oh, look, a lot of the wind power and everything has now come down in carbon footprint. So I went and had a look again, but it's still not where uranium would be if you got a new nuclear reactor. Is that still true?
Yeah, in fact, it's interesting. There was a report done by the International Panel on Climate Change in 2014, which was a real seminal piece of work, and it's basically the guidebook for emissions. And it has nuclear, I think, at 12 grams of CO2 per kilowatt hour, which is one of the lowest. The basis of that number was actually incorrect. The authors of the paper that was cited actually were still accounting for a very old, inefficient source of enrichment that's no longer used. So in fact, nuclear is actually only 4 grams. It's about a third. It's about a third of what was reported in the IPCC. Yes, and even that, I mean, that's exceedingly low. And the thing that you don't see often is wind and solar aren't normalized for backup. So wind globally probably has a 30% capacity factor. Solar varies from where you are. It depends on latitude, but a place like Perth, which is very sunny, as we know, the capacity factor for solar is only 21%. A lot of people are surprised by that, and I say, well, you have day and night, so you're starting at 50, then you've got low sun, and then you've got cloud, and then you've got dust, so it really does drop. So when those things aren't running, they need backup, and the backup is either grid or gas, and when you start accounting for the backup, which nuclear doesn't need,
that's right,
then
and
it
it's
becomes even
24/7.
higher. Yeah, so what happens is proponents for renewables, that they don't basically compare things. They're not comparing apples and apples. What they're doing is they're saying, in a best case scenario, when the wind is blowing, this thing is generating very little CO2, which is true. But when you normalize it to 24/7 power, it's not true.
Yeah, I think that's one of the misconceptions out there, and that's why an argument for nuclear. I was talking to someone just recently in Sydney. They said that there's a report that was tabled at the in China's the committee's 5-year plan is to start looking at more nuclear reactors, but in smaller sizes, like submarine size, to be placed more widespread. You know, where you can put it in the middle of a roundabout, for example.
Yeah, they're called small modular reactors, and they've been I suppose, a pipe dream for some time. But we're now seeing some real movement on that. There's one being built by Korea Hydronuclear Power in Utah, and the Chinese have just announced that they're going to invest in this. Now, we know the technology exists because, as you rightly say, submarines and ships, those ones are about 40 megawatt. So to put that into context, a reactor being built today is somewhere between 1,000 megawatts and 1,700 megawatts, particularly in China where they're building big reactors. And most coal plants are around that scale. So these are much, much smaller. And because they're modular, they can be built offshore and they can be built cheaply because it's like an assembly line. You're basically belting out the same thing over and over again. And they are small. And some of these things are basically a 25-year battery. They don't need to be refueled. They're gas cooled. They're perfect for Australia because of the remoteness of the communities. So, for example, FMG is building a crushing plant for one of their new iron ore mines that's going to need 80 megawatts of power. Now that's either going to be gas or diesel. Just can't be done with renewables. They may put renewables in, but your base loads are going to be gas and diesel. Yet a small modular reactor at the scale that we're talking about would be perfect in a place like that.
What's the cost of something like that? Just if if you were able to do that for a project.
Well, the costs are basically in the billions, right? So they're still quite expensive. And in fact, today, on a kilowatt hour basis, are more expensive than a gigawatt scale plant because it's economy of scale. The costs are coming down. The important thing about them is that you can scale up, say, a 200, 400, 800, 600. You can put them in a series. And the beauty for a place like Australia is as we slowly close these coal power stations, we can put these things where the coal power stations are because the infrastructure is all there. So basically you're just shutting down a coal power station, replacing it with small modular reactors. Is that going to happen in Australia anytime soon? Probably not. But globally around the world, I think it is. I think in the next 20 years you're going to see more small modular reactors being built than gigawatt scale nuclear power plants.
So from a VIMI point of view, I had a look at your presentation, and I know Mulga rocks because obviously when I did mine, which is the Lake Marmion thing,
yep,
we actually looked at some of the logs, and it looked very comparatively to the geology of what you guys had. So, and I was, marketing that is similar to Mulga rocks as opposed to Yeeliree,
yep,
and things like that. So where does VIMI go into, so let's say your demand? Where do you see that demand coming from? Obviously, I can see your price charts moving in the right direction. Where's that demand going to come? Where's the upside?
Sure. So demand is building. The nuclear industry is growing 2 to 3% per annum, which is solid growth. And as I say, the growth demand will be coming from the non-OECD countries. The market that we're looking at is America. So the US have 98 units operating out of a total of over 400 around the world. But those are big units, and they account for about 30% of the world's uranium market. The next biggest customer is France, which is Electricité de France. It's a single big customer. France being 74% nuclear. So we're targeting America, and we have a vice president of marketing who lives in America. He's ex-Cameco, ex-Dominion, and so he's over there talking to the utilities, and basically, and we'll talk about the 232, but the 232 basically caused an 18-month hold on all contracting activities. And so that wasn't favorable to us, because 18 months ago we finished the DFS for Mogger Rock, so we wanted to progress it. So the plan for us is basically to get contracts with the US utilities at a price that will allow for the debt that we need for the project, and then once we have contracts and we have the debt, then we would then top that up with equity and other sort of either partnership or other sorts of finance. Now, right now with the spot price in the mid-20s, people say, well, how can you get the price that you need? And we've made no secret that our study price was 60, and our price that we would probably go ahead at is 55. But we're talking being in production in 2022, 23. And that's when the next open requirements in America really lifts in 23. So you go from 30% open requirements, in other words, uncontracted requirements in America, to 60% in a single year. And the feedback that we get from the utilities is that our price expectations are realistic. So what's really important to your listeners is, and your viewers, what's really important is that they not think about today's price, they think about the price that we will be receiving at the end of our construction and when we're in production. And 55 to 60 is entirely realistic. And we know that for a couple of reasons. One is the utilities tell us that. And the second is that we can see a supply shortfall coming. Because while we're seeing slow but steady growth in demand and new builds and new reactors coming on, particularly in China, what we're not seeing are new projects coming on stream. And we can see that because Kazatomprom has decided value is better than volume, and we can see that Cameco has shut down McArthur River. They will not turn that back on until the price is sustainably higher. Both Cameco and Kazatomprom together are the price makers in the market, just like the iron ore space with BHP and Rio.
This price rise is not unrealistic, I agree fully, because in 2010 you had a similar scenario. When we started marketing, when we listed, it was at 30, just on the 30 mark.
Yeah.
And then within less than 12 months, or maybe 18 months, it was hitting 65, I think even touched 70. And,
that's right.
And that moved, in relative terms, quite quickly. And for that duration since then, where we've got this lull, this bear market, whatever you want to call it, I think in future, there's more opportunity for that to be sustained growth. I mean, from what you're saying, I mean, that's what I want to get at, is that people have this perception that uranium is a forgotten energy source, but it isn't. I think it's a future energy source, if anything. Well,
it's still 11% of the world's electricity. It's 20% of America's electricity. It's 60% of their non-emitting electricity. So it's a serious power source, and it's not going to go away. And while people and opponents to nuclear power may say it'll never come in Australia, it's like, well, I don't really care, because my customers aren't in Australia, they're overseas. It's no different than iron ore, right? Very few people sell iron ore in Australia. They sell it predominantly to China and Europe, right? So the thing is for us, the markets for us is basically America. Now, one thing I do want to talk about is the difference between spot and contract. So the spot market is what dominates sentiment. It's the price that we see listed, it's the price that gets quoted, but in reality, very little uranium is actually sold to utilities in the spot market. It's actually not even the correct name, so it's not even a market. So the spot market in nickel and copper and gold is a true market. It's an open market where it's a trading house where the metal is traded openly, and it's a supply-demand economic. The spot market in uranium it doesn't work like that. It's actually an arbitrage market. So the spot price should actually be called the arbitrage floor price, because what's happening is after the big uranium run-up of the price in 2007, a lot of traders entered the market, and these are arbitrage traders. And arbitrage is just simply buy low, sell high. And for that to work, they absolutely have to pay the lowest price possible for uranium, and then they get enough uranium that they can actually sell into a contract. So they're competing with miners. So what happens is the spot price that you see is actually, it doesn't reflect the average contract price that's happening around the world. And most utilities buy on contract. But what has happened is, over time, since 2007, we can actually see that there's always been a delta, or a difference, a positive delta between the spot price or the arbitrage floor price and what's called the term price, which is basically a long-term contract, not an average of all long-term contracts. There's always about a 20% difference. When we see a spot price of, say, $30, you know that the contract prices are being written at 50. Right, and the last time we saw the spot price ramp up, people were locking in contracts at 60 and 70. So what's important for your viewers is to understand that the spot price is an artificially low price. It's based on traders trading amongst themselves, trying to make a margin between buying it low and selling it high, but doesn't reflect the contract price. The contract prices, unfortunately, are confidential. But what we do know is that by and large, the contract prices are almost always 20% higher at a bare minimum to the spot price. So right now at a spot price of, say, $25, we know that we could go get contracts today at 40. But that still doesn't sustain global production. When you look at the all-in sustaining cost of global uranium production, as you would with any other commodity, the marginal cost of production for uranium is 55, right? So anything below 55, but they're being sustained by long-term contracts, right? So nobody sells into the spot market. If you were to say today, let's say we have no more contracts and we just have a spot market. Well, at $25, 2/3 of the world's uranium would close down, right? So the point is that the spot price, while it drives sentiment, is not important. What's important is what will the contract price I get in 2023 when I start production. That's what's important. And so, unfortunately for us, we need to announce a contract to prove that will be the case. And that's certainly where we're putting a lot of our effort.
Yeah, that makes a lot of difference, though, in terms of who you are, what you are, if you're a miner.
Yeah.
And obviously, a lot of these reactors need supply, so like win-win scenario.
Well, and the other thing is that the cost of uranium oxide going into a plant, when you amortize that over the number of kilowatt hours it produces, it's less than a cent per kilowatt hour for every $10 that the price moves. Fuel all up for the whole fuel cycle, from mining through conversion, enrichment, and making the fuel rods, is about 30% of their total costs. Most of their cost is capital. And when you're running one of these things, the last thing you want to do is run out of fuel. So security of supply is very important. And that's why the utilities are writing contracts now. Well, it will be once the 232 is cleared through the market and their psyche. They'll start writing contracts for delivery in 22 and 23 because they want to know that they're going to have supply in those periods. Because the other thing that people don't realize is that when the yellowcake leaves my gate, it's 18 months to 2 years before it's even in a reactor core because of the nuclear fuel cycle. So it's a really different market. It's a market for the long players. The short-term guys who want sugar hits, well, that's lithium, gold, it's all the shiny, blingy stuff. But people who play the long market and are looking for good returns over a long period, that's the uranium market. And that's why you're seeing contrarians, particularly the guys that we see on Twitter, like Mike Alkin and guys like that, who are contrarians, doing well, and I expect them to do well going into the future, because uranium is for the contrarians. It's for the people. It's a bit like The Big Short, that movie, The Big Short. There were those 4 guys who figured it out, right? And what's great is in the movie they say, well, the reason they figured it out is because they asked. Right? So anybody looking into the uranium market starts asking questions, they're going to say, holy mackerel, this I need to be in this market, right?
Oh, it's like everything else. Like I remember 2015 January, it looked like the market hit the bottom. But everyone said, oh no, because that was a fear factor.
Yeah.
Everyone's going, oh, it's going to fall off the cliff. I said, well, you can't have gold price going down below 1,000.
That's right.
And sustained.
That's right.
Because no one can make, all the gold mines are closed, But a lot of the masses will be saying, oh no, it's going over the cliff, it's going over the cliff, but they never look at the consequences of going over the cliff. You know,
it's funny about gold. I remember in the mid-90s, I was working as a resource geologist, so I was doing all this 3D modeling on some really, really grunty software. And we used to do some work for an Australian gold company, I won't name them, but their policy was that they would do a 750 pit shell. So we do an optimization, and we would do a $750 pit shell, and anything outside that shell wasn't even a resource, because it just was never going to be economic, right? And that was in the mid-90s, so that's kind of 25 years ago. It's kind of funny how things change. But yeah, uranium is certainly, the Big Short is really a good parallel, because there was this thing coming, people didn't see it, the people that looked saw it, and it's the same as uranium. So, investors looking for good leverage. The junior space is probably a place where you're going to get multiples of leverage. The bigger companies like the Paladins and the Camecos, who are going to be producers again and are producers, good exposure there as well. But for people looking for the multiple baggers, the companies sitting in a junior space who have advanced projects, who have approvals, with a study price in the 50s, 60s, and maybe even the 70s. Those are the projects people should be looking at.
No, it's a fascinating topic. I mean, we could go for ages here.
Oh, we could. We could go for longer than the half-life of uranium.
Maybe not that long. That's a long time.
That's a long time.
But I don't know if you remember, you actually interviewed me 2008. You had an office down there.
Yeah,
DC Iron had just started.
Right. We had too.
And you were upstairs in a little old office.
We were number 8 Clive Street.
Yeah, you never gave me the job though.
What was the job for?
I can't remember.
Was it the COO's role?
No. It was like
Or was it
exploration manager or something geological. Okay. Something geological.
I apologize for that. Yeah. Don't hold it against me.
Yeah.
I wish I had.
I had a picture of you in my house, and I was throwing darts
at it. Yeah, I kept getting a headache, and I couldn't figure out why.
Maybe down the road we could do an update or something.
Absolutely. The other guy you want to talk to, there is a really interesting catalyst coming in the uranium market, and that's in early September, the World Nuclear Association published their biennial fuel report.
Okay.
And historically, that has always shown oversupply under demand, and there's some political reasons for that are now gone. And this report will be a lot more realistic in terms of where future supply will come from and what future supply will actually come on. And that's going to be an interesting catalyst, because that's going to categorically show a shortage in uranium. That's going to be really interesting. And I think after that's released in September, I think it would be good to get Julian Tapp, who works for us, get him in. He's ex-Fortescue. He's my quant, there's that famous scene in The Big Short where he's saying, look at the quant, this is the guy that knows everything. And Julian's the guy that does the numbers, and his brain is the size of a planet. So he's actually on the working group for the WNA. Okay. And once that report's released, he'll be able to talk about, basically how they went about it and why this particular report is going to be so important. And I call it a slow burn catalyst, because once people start looking through that report, and it will be technical, they're really going to have a eureka moment and say, hey, there is a shortage coming.
Oh, I reckon the uranium outlook's really good. It's just a case of timing.
Yeah.
How long will it be? But like you said, if you put your money there and just don't worry about it, I think you'll more likely make money of it. Yeah. Whether it's 12 months, 24, 2 years, 3 years.
Absolutely. And look, the last thing I'll leave your viewers with is this. I was very successful with BC Iron. I mean, we went from our first drill hole to first ore and ship in less than 4 years. Uranium takes a lot longer, and at first it frustrated me, but I want to see this thing through, right? I mean, obviously there's a lot of other commodities which come and go. We've seen lithium come and go, graphite come and go, gold has come and probably staying. And there's lots of other opportunities for me to go out and make a lot of money, right? I could go do other stuff that would be easier. This isn't easy. But I want to see this through, because I believe in the space. I love uranium. I believe in nuclear energy. and I believe in our projects. You know, so I'm here for the long term, and I'm going to make this work. And I've got shares in the company. I've bought shares. We're doing salary sacrifice to buy more shares. You know, so I believe in the space, and I'm putting my money where my mouth is. So, you know, happy to have another interview, so I can tell your listeners I told you so.
Well, before that, I'm actually really interested in your actual resource, but we'll do that another time.
Yeah.
Because I actually like you're very different to the others out there.
It is.
But I think we'll leave that for the next one.
Well, there's some good background in it in the various presentations, but in a nutshell, it's an old river channel. It's basically a dirty lignite, all the uranium's with the carbonaceous material, and it's all free dig. I mean, when I was first presented this project back in 2013, the things that really stuck out to me was how big it was, how simple it was, and the fact that we had no competing land interests. So, you know, it was all about the market and all about approvals, and we're working through that now.
And it's completely different to the Uliri styles.
Oh yeah, absolutely. Uliri's a calcrete deposit, whereas this is basically this is not too much different than what you'd see in roll fronts, where you've got carbon acting as a reductant, but the geology of this deposit doesn't lend itself to in situ leach. So we'll mine it by open pit. But because it's basically a sandy river channel, it is free digging. It's basically you're mining sand, and then the treatment is very simple, very low risk. So technically, the project has very low risk. All the risk is on the commercial side, and we'll mitigate that risk by getting contracts and get the debt funding.
Okay. All right. Thanks. Till
No worries.
next time.
No worries. Thanks very much.
Yeah.